Hello, everybody, and thank you for joining us for today's AREAA, What to Expect in the Post-Pandemic Real Estate Market. My name is Rick Sharga. I'm an Executive Vice President at RealtyTrack and longtime fan and supporter of the Asian Real Estate Association of America. So delighted to be invited to join you today and delighted that you're joining us. I am joined here by my good friend and longtime colleague, Darren Bloomquist, who is the Vice President of Market Economics at Auction.com, the leading online marketplace for property auctions online, and one of my alma maters. So Darren and I have a lot of shared experience. We're going to cover an awful lot today, so I'm going to kind of jump right in the interest of time. To give you an idea, we're going to be talking a little bit about what's happening in the U.S. economy, which obviously has a lot of implications for the housing market. We'll talk about the market itself, talk a little bit about the commercial market, because I know a lot of agents involved in the AREAA family are also actively involved in the commercial market. Darren is going to do a real deep dive into what he's seeing in the forbearance program, what he sees in terms of the foreclosure outlook. Hopefully we'll have time for a spirited debate about whether those numbers are accurate, because that's always a lot of fun. And then we'll share some final thoughts with you at the end of that. Again, a ton of content we're cramming into this. We're both very happy to make our presentations available for anybody who'd like them afterwards. So if we rush through something, you'll be able to get a look at the data, a look at the charts as we go through this. Also, if you have any questions during the course of the event, feel free to add them into the chat or comment section. We'll try and answer them as we go or at the end of today's session. And failing that, we'll be happy to answer them afterwards via email. So what's going on in the U.S. economy? Well, in case you haven't noticed, there was a pandemic and it really kind of wreaked havoc with the economy. We had a record drop in the GDP, which is how most people measure the state of the economy. Last year, a 31.4% drop in a single quarter, which has never happened before. And that was followed, interestingly enough, by a record increase the following quarter. What's happened since then is we've continued to grow, which is a good thing. Growth slowed down dramatically after that record increase, but still remained in positive territory. In the first quarter of this year, the preliminary records show that we're at about 6.5% growth. And most of the economists that I follow, most of the reports that I've seen so far, are expecting to see the GDP growth for the year this year somewhere between 5 and 7%, which it will be the highest it would have been in many, many years. So all of this shows that the economy is recovering very, very rapidly from the economic shock that was imposed when the pandemic was declared and the shutdown orders were put in place. And keep in mind that this kind of drop was expected. The U.S. economy relies on consumer spending for about 70% of the GDP. And basically when people were forced to stay home and weren't able to buy a whole lot of things other than what they could get on Amazon, the kind of drop off we saw was expected. The recovery has actually happened much faster than most economists predicted. Housing share of the GDP at this point in 2021 has recovered really very, very well and is at a 14-year high. Normally, housing accounts for somewhere between 15 and 17% of the economy. And that has to do with the amount of money that's spent on new construction, on services that are used by people that are buying and living in homes, by rent and imputed rent. There's a whole formula that goes into this. But you can see that the housing recovery has been so strong that we actually have a housing share of the GDP, housing's contribution to the economy, a little higher than what it normally is. So the housing market, forget about it as a standalone, has had a major contribution to that recovery we talked about a couple minutes ago. Consumer confidence is also coming back. We saw it fall off a cliff. The bars here are consumer sentiment. You see that survey done very regularly. University of Michigan does it. And the dotted line here is consumer spending. And typically those things run in tandem. If consumer confidence is high, consumer spending tends to be very high too. And they both fell off a cliff when the pandemic was declared early in 2020. Spending has actually come back more strongly than sentiment, although sentiment has begun to climb back pretty in a pretty healthy manner. Some of the issues we had with sentiment are where we went through a second and then third wave of COVID infections. And that's when you saw consumer sentiment begin to improve and then fall off again. But interestingly, we've seen the spending level come back and not quite to where it would have been without the pandemic in place, but at very, very strong levels. Unemployment similarly has recovered pretty smartly from where we were. We were at an unemployment rate of 3.5% entering the pandemic, which was the lowest rate we'd seen in about 50 years. Overnight, literally overnight, that unemployment rate jumped to almost 15%. But as you can see, that unemployment rate has come back down. Unemployment numbers were announced this morning. I think it was about 437,000 unemployment claims, which is the lowest since March a year ago, prior to the pandemic being declared. So we're seeing the unemployment numbers come down. We're seeing the unemployment rate come down. And again, both of those have come down much more quickly than most economists had projected, and far, far more quickly than what we've seen in prior recessions. So if you just take a look at the previous recession, which started right around 2008, the Great Recession, it took the better part of a decade for the unemployment numbers to come back to where they were prior to the recession. And in this case, very, very likely that within somewhere between 18 and 24 months, we'll be back at the employment levels we were before the COVID-19 pandemic hit.
Hey, Rick, can I ask a quick question?
Sure.
The latest jobs report was a bit of a disappointment.
Yes.
With 266,000 jobs added, which was much lower than the 1 million I think expected, whatever expectations mean. And then also the 6.1% unemployment rate was up a little bit. Any thoughts on, is that just a bump in the road, or any concerns that that's reflective of some kind of interruption in this recovery?
That's a great question, and I'm sure you have some thoughts on that too. So very gracious of you to ask me for my opinion. I believe the unemployment rate is to be expected. We're also seeing a subsequent increase in people in the workforce. So people that had exited the workforce and were no longer looking for employment have been coming back in. So as you have a higher labor force participation rate, and not all those people immediately finding jobs, it's kind of normal for unemployment rates to stagnate or maybe even go up a little bit, just as we have more people re-entering and looking for work. The jobs number was a little more troubling, but you know, the explanations that I've seen that seem to make sense are a lot of industries are having a hard time hiring people right now, particularly the service industries, which is where really the bulk of these job losses took place. A lot of speculation that in these industries, which typically are not high-paying wage industries, it's actually less lucrative for people to come back than it is to collect the enhanced unemployment benefits that they're collecting due to the stimulus programs that have been put in place. So restaurants, retail outlets, entertainment facilities, other people that hire those types of jobs are having a really, really difficult time bringing people back into the workforce. There's probably a little bit of reluctance from people as well, just because of lingering COVID fears. So I do think it's a bump in the road. The unemployment benefits, the expanded unemployment benefits are due to expire in September. I think if we don't start to see jobs come back between now and then, we might be looking at a more severe issue than what I'm expecting. Do you agree with those, or do you have some other thoughts on that, Darren?
Yeah, absolutely. I think that's right. I think it's kind of it's a good problem to have, I guess, is what we're having right now. Is there's a lot of jobs available, and employers are having trouble filling those jobs. It's probably a much better problem to have than the reverse.
Yeah, when we were at 3.5% unemployment there were still jobs going unfilled. There tended to be geographic mismatches and skill set mismatches. This time, that's not necessarily the case, but we have people that are reluctant to go back into that workforce for a variety of issues. That said, we've still recovered more than half of the jobs we lost. And one of the big differences in this pandemic, there are two big differences really in this pandemic recession compared to other recessions. One is the rapid rate at which these jobs have been recovered. And the other is that the job losses tended to be very, very focused on a handful of industries. They tended to be in industries like retail, restaurants, hospitality, travel, tourism, entertainment. And again, those tend to be lower paying jobs. They tend to be populated by people with less formal education. They tend to be younger workforces. Because of all of those factors, they tend to be less likely homeowners and more likely renters. And so one of the reasons that the housing market hasn't been hit as severely as it's been hit in previous recessions is because a lot of the damage this time really was among the renter population. And you can see that the jobs that haven't come back yet, more than a third of these jobs that haven't come back yet are in the leisure and hospitality industries. And there's a whole variety of different types of jobs that go into those categorizations. Manufacturing is also having a little bit of trouble bringing people back in. The construction market is having trouble finding labor, particularly skilled labor. But again, the service industry jobs, again, industries that tend to be skewed more heavily toward renters than homeowners are where a lot of these lingering job losses remain. The rapidity of the economic recovery, the strength of the economic recovery has really been evidenced nowhere more than in the housing market. Existing home sales are off to a strong start. And I know Darren and I agree on this one. As you're looking at home sales numbers this year, whether they're existing or new home sales, I would urge taking them with a grain of salt, because last year was such an unusual year in terms of how the cycle played out, that this year's numbers are going to be a little fuzzy when you try and compare them on a year-over-year basis. If you look at the blue lines here, those are 2020 home sales. And you can see that we went through February and March. February was pretty normal. March, toward the end of the month, sales activity dropped off when the pandemic was declared. April, May, and June, which are usually months where we see home sales increase, we actually saw declines in April and May, and then a year-over-year decline in June. Market recovered in July and August and then never looked back. We had a very, very unusually strong second half of the year. And what's likely to happen this year, I believe January, by the way, was sort of capturing the tailwinds from last year, and also much stronger than what we normally would have seen in the first month of the year. February and March numbers have been down a little bit month over month, but still much stronger than they were on a year-over-year basis. So what's likely to happen is we're likely to see very, very unusually strong year-over-year growth in April, May, and June. In the second half of the year, the numbers may not look as strong. And again, I'd urge you not to look at that as a sign of weakness in the housing market, rather to look at that as really an indication that the cycles are kind of leveling off and going back to normal. But these home sales, I get a lot of data and read a website called Calculated Risk pretty much every day. And it's kind of a running joke now that every day you'll see on that site some state where the annual sales went up year over year and the inventory went down year over year. And it's reflective of the whole country right now. We're at historically low levels of existing inventory for sale. And we are continuing to see year over year increases in property sales in spite of that. So in a normal market, we'd be looking at a little over 6 months of supply. So it's how much inventory is available relative to the demand that's being put into the market by home buyers. We're running at about a third of that right now. And the numbers, depending on whose numbers you follow, NAR suggests there's about 1 million homes for sale. They do it on a monthly snapshot. Altos Research says there are only about 300,000 homes available for sale, and they do it on a weekly basis. But however you cut it, there's just not much available for sale, and what goes for sale gets sold very, very quickly. This is nowhere more true than in the new home sales market. where last year was a much stronger year than we anticipated. And this year is outpacing last year pretty significantly. We're at a run rate right now where we could approach 1 million new home sales over the course of the year. I'm not sure we'll get there, but new home sales are actually, on a percentage basis, doing better this year than existing home sales are, if you look at improvement rates. And it's also true that the inventory of new homes available for sale, and if you look at the red area on this chart, those are completed new homes that are available for sale, also at historically low levels, the lowest since this data has been collected back in the early 1970s. What's interesting here is we're seeing more and more new home sales being sold of properties that are under construction. That's the blue area here, or properties that haven't even been started yet. So when people ask why we don't expect the same sort of problems this time that we saw in the Great Recession, this is one of the indicators. In the Great Recession, builders build out assuming buyers were coming. So they actually overbuilt during the housing boom, and there was leftover inventory when the boom shifted into a bust. That overhang of inventory caused home prices to go down. In this case, the builders are actually selling to buyers who are buying before the properties are built, and in some cases before the properties are even started. So a very, very different market dynamic. And this supply and demand imbalance also leads me to believe that for distressed homeowners who may find themselves in default coming out of the pandemic, the option really exists for the majority of them to be able to sell their property at full market value in many cases in order to avoid a foreclosure. Darren's going to go into much more detail on some of those numbers during his part of the presentation, so I'll leave a go at that. But demand continues to be strong. This is purchase loan applications from the Mortgage Bankers Association. Last year, the dark blue line there ran again in a sort of, the gray line ran in a sort of counter-cyclical manner. You can see it dipped in the second quarter of last year when the pandemic was declared. So it ran much weaker than usual during this time of the year, but then was stronger for the balance of the year than it normally is. The red line, which represents this year, is still running ahead, well ahead of last year's pace at this time of the year, but also running ahead of 2019, which was a more normal year. So demand continues to be strong. Demand is driven really by three things. One is demographics, and this would have been true whether or not we had a pandemic. And what you hear mostly about are the millennials. The largest cohort of millennials, which is the largest generation in US history, are rapidly approaching the prime age to buy a property, to be the first-time buyer. So that demographic trend was in place before the pandemic hit. The one you don't read about as much, but also true, is that the Gen X generation has a large number of people rapidly approaching the age of a repeat buyer. So it's interesting that we have two age cohorts that are both moving toward prime buying age for both first-time buyers and repeat buyers. So those demographics really are a primary driver. Secondary driver, which we really can't overemphasize enough, is that interest rates are at or near historic lows. When we're worried about interest rates being almost back up to 3% on a mortgage, it just tells you how remarkable this market has been in terms of interest rates. For as high as home prices have been, interest rates have been low enough to offset most of those price increases. As of a couple months ago, the average mortgage payment compared to a year ago, despite record level median home prices, was lower in 49 of the 50 states, with the golden state of California being the exception to the rule, where prices rose so rapidly that they offset this balance. But according to data from my parent company, Adam Data, in more than half of the markets across the country, your average payment on a 30-year fixed rate loan is actually lower than what you would pay to rent a similar property. So for a lot of people that are weighing whether they want to be homeowners or renters, these interest rates really have had a material effect. The third thing that's driving demand, just quickly, is the pandemic itself. We have seen an acceleration of a trend that had already started, with urban renters moving and becoming suburban homeowners, and even homeowners in the far suburbs and rural areas. People looking for bigger homes, people looking for more space between homes. With the ability now to work from home, they're less concerned about the commute time and more concerned about perhaps having a home office. So we are seeing people moving further and further away from urban areas. Again, they're transitioning from renter to homeowner, which they were doing prior to the pandemic, but the pandemic really has had an impact on increasing that. And that's particularly been true in high cost markets like San Francisco, San Jose, Seattle, and New York City. So secondary markets and suburban markets have benefited from that. Limited supply, high demand always leads to higher prices, no matter whose numbers you're looking at. You can see that that the median sales price for both single family units and condos have gone up dramatically on a quarter over quarter basis, and home price appreciation is off the charts. I think NAR or somebody announced recently a 17% year over year increase in home prices, which is just insane. Before you ask, I don't believe Darren or I either believe that we're in bubble territory. But if you're looking at 17% year over year prices on a consistent basis, we're going to get there sooner than later. The wage growth we've seen, the low interest rates can only continue to offset these home price increases for so long before we do find ourselves in affordability problems. The increase in prices, though, is also driving equity to all-time highs. We're at over $21 trillion in equity now among homeowners. And this equity, which Darren will also do his best to dispute later in today's discussion, not really, but he'll give you a different slant on this that I think is really interesting. But this amount of homeowner equity also is very, very different than where we were during the Great Recession. And if you look back at what happened between 2005 and 2011, there was a net decrease of about $6 trillion in homeowner equity. So people that found themselves in default very often didn't have an option to get out of foreclosure. I believe we peaked, and Darren, correct me if I'm wrong, but I believe we peaked at almost a third of mortgages being underwater at the nadir of the housing market. And there's probably less than 3% of homeowners who find themselves underwater on their loans today. So the equity levels are very different than what we saw last time.
Yeah, I think that's about right. And it was certainly a very high percentage. I did want to interject with just a question of, I do agree that the way I've heard it described, this isn't with me originally, is that we're in the early stages of a housing bubble. A housing bubble hasn't formed yet, but to your point, if we're seeing 17% appreciation, which we have been seeing double-digit appreciation for about 8 months now, that will quickly lead to some kind of imbalance. But the question, I guess, for you is what can slow down this runaway train of the housing market? Because I think it's healthy if it was slowed down a little bit. But do you see anything that will slow that down?
I do. I think at some point we will hit an affordability wall where prices will simply exceed people's willingness or ability to pay that much for housing. I also think interest rates could go up a little bit. There are now some inflationary issues that are coming to the market that could cause interest rates to go up. And again, I believe the low interest rates have been a big part of why people have been able and willing to afford properties as values go up. And then obviously the third thing is inventory coming to market. The builders are building more. Would not be a huge surprise to see 1.5 million units built over the next couple of years each, which will help. And I believe as the pandemic feels more and more like it's under control, we'll also start to see existing housing stock come back to market. We'll see millennials moving out of their parents' homes. We'll see parents downsizing. We'll start to see some of the more normal trends in terms of existing home sales. So the combination of those things, prices just hitting a natural wall, interest rates going up, and inventory coming to market should all contribute, I believe, over the next 18 months to slowing down the home price appreciation.
I think that would be a good thing.
I think we're all in agreement on that.
Yeah.
At the risk of giving another insight into where Darren's going to be going a little bit later on, we saw distressed sales most recently at a 17-year low. They typically run in the single digits, but we're now below where we were not only prior to the pandemic, but prior to the boom and bust cycle that categorized the early 2000s. And the reason for this is there's not much inventory available. Both foreclosure starts and bank repossessions are now virtually stopped. Adam released its most recent foreclosure report for March foreclosures just this week, and we saw basically foreclosure activity flatline for the month. And was off 17% year over year, which is amazing because last year at this time was the first full month of the pandemic. And we saw foreclosure activity drop by 75% that month. So 75% drop from 2019 to 2020 and another 14% this year, same month. So there's very, very little foreclosure activity going on. And what is going on is primarily vacant and abandoned properties and commercial loans. And Darren's going to go into this in much, much more detail very quickly on the commercial market because I'm running a little over, want to give Darren full time. Sales are down across all the categories. Most recent data that has full month data being reported. We're looking at apartment sales being down by almost 40%. Retail and office down by over 70%. Industrial sales down, but that's a little misleading because there was a multi-billion-dollar sale transaction that happened a year ago, which kind of skews the industrial numbers a little bit. And hotels down again by almost 50%. So in virtually every category of commercial sales, we're seeing less sales activity year over year. Not surprisingly, we're also seeing prices down regardless of which property indices you're looking at. And that's been especially true in the hotel business, in the retail business, less so in the office market. And residential is still a little bit better than flat. So again, the industries hit hardest by the pandemic were retail and hospitality. It's probably going to take them the longest time to recover. Again, so sales volume down, prices down, and delinquency rates are up. So if you're looking at, again, the worst hit categories, retail and lodging, the bad news is delinquency rates on those loans are much, much higher than normal. There's actually a higher level of REO activity, but the good news is in most categories, especially those two, we're seeing those delinquency rates begin to come down, which is a good thing. One of the anomalies we're seeing, and this might be a little different than some of the conclusions Darren will share with you in a little bit, but this is a snapshot of one part of the commercial market. In our Realty Track database, we're seeing that commercial foreclosure starts predominantly are running at about 5 times what they normally run if you're looking at loans of $5 million or over. Now that sounds scary, but it's a very, very small base. So we're seeing about 50 properties a month entering into foreclosure, whereas normally we'd see about 10. So the numbers aren't huge, but the relationship to normal levels of foreclosure activity is nonetheless pretty telling. And I think, again, that speaks to the lack of protections that we've seen in the commercial market compared to the residential market. I'm going to just, I'll leave these up here for a second, but I'm going to kind of skip through these because we've talked about most of them. What I will say in terms of segueing to Darren's slides is that our perspective at Realty Track is that default activity is definitely going to increase. You can't lose 22 million jobs and not have an increase in defaults, but very unlikely to reach the levels we saw during the last cycle. And that commercial markets could see higher than usual levels of default activity. And that there are 2 other areas of potential weakness. One is the FHA loan portfolio, which I know Darren's going to go into in detail for a variety of reasons. And markets with high concentration to single family rental properties where the owners, the mom and pop investors are getting financially stressed because of the eviction bans that have been in place for the last 14 months. So with that, I'm going to stop sharing. Hand it over to my friend Darren, and he'll take us through the second half of today's conversation.
Awesome. Thank you, Rick. And hopefully you guys are seeing my screen now.
Yes, we are.
But yeah, great stuff. And I'll dive more on into the distress side. Certainly that's what we're looking at more here at auction.com. And one of the things you mentioned with those foreclosure starts, that did surprise me, because I just pulled up really quickly our data from April, and we're showing, we look at two metrics. One is called brought to auction, the number of properties brought to auction on our platform. And those were up 1,700% from a year ago off of a very low level, obviously in April. And our actual properties sold was up over 3,000%. So that may, again, it's coming off of an extremely low level. And so that's what we'd expect. But it is surprising. It may be that the public record data is lagging just a little bit there with the April numbers.
Darren, we've seen foreclosure start activity go up 3 months in a row prior to this. So and as you know, there's a lag time between a foreclosure start and being brought to auction or being sold. So it's likely you're seeing the activity from what we saw a couple months ago.
Yeah, so before anybody quotes me on a 3,000% increase in foreclosures, let's get into the actual planned stuff here so that I can nuance that. But this heat map is just basically showing where we're seeing foreclosure inventory return, and the percentages are relative to year ago levels. So this is in the first quarter of this year, 2021, relative to 2020. So almost every state, there's a couple exceptions, are below 100% of pre-pandemic levels. Nationwide, we're at 30% of pre-pandemic levels. Another way of saying it, we're 70% below pre-pandemic levels. But the big takeaway here for me is that the Southeast and the Midwest are where we're seeing the foreclosure volume return in the biggest levels. Now, a lot of those states are very small volume states. Some exceptions to that are Florida at 34%. We're starting to see the foreclosures come back there. And places like Tennessee and Indiana are higher volume as well. Texas is a little bit of a surprise because they have a very quick foreclosure process in Texas. We're only at 13% of year ago levels, and that may be due to some of the winter storms that they've had there, causing some additional delays in foreclosure on top of the foreclosure moratorium that's in place. And one question that may come up is, well, I thought we were in a foreclosure moratorium. Why are foreclosures happening at all? And as Rick referenced earlier, these are almost all on vacant and abandoned properties, but there's also about 30% of the market that is not under the foreclosure moratorium. And I'll reference that in a little bit as well. But we are seeing some of that volume start to come back, particularly in the Midwest and Southeast. In terms of property type, and I pulled this from Adam Data Solutions, RealtyTrack's parent company. So this is not the heat map was auction.com data. This is more market-wide data. In terms of what we would define as completed foreclosures, you definitely see the commercial space getting hit harder. The bars in blue are commercial types of properties. And overall commercial, we're at 44% of year ago levels versus 26% residential. Again, looking at it through that same prism of comparison to year ago levels. And multifamily, large multifamily is getting harder, as you can see there, along with retail and office, as Rick mentioned. But then single family residence, we're at 24% of year ago levels. So commercial definitely is being hit harder because I think there's not as many protections, and also because the economic shock from the pandemic impacted that space more than the residential space. What this is through the prism of loan type, and what stands out to me here is this is again auction.com data. So setting it back, so again 30% of year ago levels overall. FHA is at 33% of year ago levels, which isn't that much higher, but what stands out even more about FHA is that it's representing 29%, almost a third of all foreclosure volume, which is very disproportionately high. We see FHA accounting for about 15% of all active mortgages. So the percentage of foreclosures that they're accounting for is much higher than their share of the overall market. whereas you see conventional loans, Fannie and Freddie, at about 30% of year ago levels. And then the private and MPL book, which are non-performing loans, those would be outside of the foreclosure moratorium scope. But we see those lenders and servicers still acting pretty much in lockstep with the moratorium, and we see about 28 less, actually lower, 28% of year ago levels there. And so they are sticking, at least at this point, to the script that's been written by the government backed loans and primarily foreclosing on just vacant and abandoned properties. I did want to dive into FHA a little bit more because that does stand out as, and we were, even before the pandemic, we saw that as an emerging risk factor in the market with the types of loans that FHA was originating. We're getting increasingly risky, higher LTVs, higher DTI ratios leading into the pandemic. And so here's just a heat map. And by the way, on all the heat maps I'm sharing, there's interactive versions of those behind that I've provided links to that you guys can dig into. But with the FHA, you see the red spots are where we see a lot of volume and high seriously delinquent rate of FHA loans. So some of the markets that stand out with a lot of volume of seriously delinquent FHA loans are Atlanta, Houston, Chicago, whereas the Northeast has some of the highest rates in terms of those FHA. And so those where we would expect to see some of those turn into foreclosure inventory eventually. But a step back on the FHA, which I found really interesting, is that forbearance is really working very well for FHA loans. 79% of seriously delinquent borrowers who have an FHA loan are in forbearance. So the vast majority are being protected by that. And so that was a program I think we'll look back and say that this forbearance program was a lifeline, a game changer to protect the housing market from much more catastrophic consequences as a result of the pandemic. And you see a lot of people being protected by forbearance, particularly in this high risk category of FHA. Now, the risk factors here are very low. The loans that are at risk for foreclosure, at least in the immediate future, are very low. You see there on the right-hand side, I've broken out those that are not in forbearance and don't have any loss mitigation actions taking place. And combined, those only represent 2% of the FHA seriously delinquent book. So that's the good news. The bad news is at some point, those 700,000 seriously delinquent FHA loans that are in forbearance, being protected right now by forbearance, will have to be dealt with, other than just giving more time, as I'll get into in a little bit here too. And then that same metric, that 79% of seriously delinquent FHA loans being protected by forbearance. Now, here that number is by state to show you some of the states that might be at risk for seeing higher levels of FHA foreclosures earlier. And this does align somewhat to the heat map I showed earlier of where we're actually seeing foreclosures take place, where you see the Southeast and the Midwest greener numbers, meaning that a lower percentage of seriously delinquent FHA loans are being protected by forbearance. And so Puerto Rico is not on the map, but it's the lowest at only 52%. And then you have Oklahoma, Louisiana, Ohio, and Kentucky with well under the national average of 79% of seriously delinquent FHA loans in forbearance.
And Darren, just to emphasize the point so nobody walks away with the wrong screen capture here, is we're talking about the percentage of seriously delinquent FHA loans, not the percentage of all FHA loans.
Yes, very, very good point. These are loans at risk and the ones that you would expect to see in forbearance. Yes. So shifting now to looking forward a little bit on what what happens when forbearance, some of these protections start to drop off, the main ones being forbearance and the moratorium. And we do see the potential brewing for a summer foreclosure surge. Maybe surge is too strong of a word, but if you look at the numbers, right now the moratorium is scheduled to lift in June. We would not be surprised if that is extended beyond June, but at this point it's through June, and the CFPB is coming out with rules that could create a de facto moratorium as well that extends. But anyway, going with the facts that we have now, on the left-hand side, we have one group of foreclosures or properties that could go to foreclosure fairly quickly if that moratorium lifts. And that's about 300,000 properties. And this is not FHA, just FHA anymore. This is all loan types. 300,000 that are seriously delinquent that are not in forbearance, entered forbearance, left forbearance, and are not in any loss mitigation. So if you look at those, those are at high risk for starting the foreclosure process once the moratoria lift. Right now, they're being protected by the moratoria. And then on the right-hand side, you see when looking at the ones that are being protected by forbearance, when are those going to exit forbearance and then be at risk for potentially foreclosure? This, by the way, all of this data is from Black Knight. They do a really good job of looking at these forbearance numbers along with the MBA. And over the next few months, really starting in June, July, specifically, you have about 1.4 million properties scheduled to exit forbearance. And if I go through kind of the math there, but based on the current rates, you'd end up with about 135,000 properties of those 1.4 million that exit forbearance that would go into that bucket of not in loss mitigation, and those would be at risk for foreclosure. And so if we saw that, you would see potentially a jump in foreclosure starts. I believe just to set the bar, we had, and Rick, you might be able to correct me on this one, that the foreclosure starts in 2019 were around 300 to 350,000.
Yep.
And so we're talking about over a full year's worth of foreclosure starts potentially coming to the market, probably not all at one time, but fairly quickly after any moratoria is lifted. And just quickly, I mentioned this earlier, that the types of loans that are failing forbearance at the highest rate are those portfolio loans that are not government-backed loans, not FHA, not Fannie or Freddie, and or private label securities. And both the Black Knight shows that on the left-hand side with the red there, and on the right-hand side, MBA is showing exit rates. The most recent week, at least that I pulled from the MBA, showed 22% of those portfolio and private label security loans were basically failing when they exited forbearance, were in what I would call failing forbearance. They're going into loss mitigation, or not loss mitigation, but they're still delinquent. So that's a risk category to keep an eye on as well. And then moving to really what I think is the core, I think in some ways trying to figure out all the forbearance programs and the moratoria impact is a little bit, confuses the issue. Really at the core of the risk we have in this market with the distress market is properties that are seriously delinquent, specifically 90-day plus delinquent, taking properties in foreclosure out of the equation because of the foreclosure moratoria. But really, that's where we see the pig in the python, is we have these the graph on the left is showing 1.9 million homes that are still 90 days, or loans, I should say, that are 90 days plus delinquent. And the earlier stage delinquencies have been coming down, are even below pre-pandemic levels. But that 90-day delinquency bucket has remained stubbornly high and is about 1.5 million in excess of what we were seeing pre-pandemic. And so that's the industry and the real estate market is going to have to deal with that group of loans. Right now, the strategy of giving those homeowners more time has helped to a certain extent. But if you look at the blue line on the right-hand graph, that's that 90-day bucket. It's not quite flatline, but it's not coming down at a very fast rate. And so that's a group of distressed homeowners who are going to probably need some path out of that other than just more time.
Darren, not to gloss over the severity of the potential problem, but we have had reports from most of the people that track this that obviously overall delinquency rates have been going down, and even serious delinquency rates have been coming down, although not as fast. But when you look at that trend and also recognize what you've been talking about for a few minutes now, that the overwhelming majority of those seriously delinquent loans are in forbearance, I'd ask if it doesn't make a little bit of sense to look at those numbers a little differently than how we might have looked at seriously delinquent loans in the past. Whereas if you were a year behind on your payments, we're not talking about loss mitigation. We're talking about why you haven't been foreclosed on yet. But a pretty different scenario in today's market, right?
Yes, I would say so. I mean, I think there's an understanding with the industry and with government policymakers that this batch of seriously delinquent loans is different. It's created by, something beyond most people's control. So I think that's a very fair point. Just another graph to illustrate this 90-day issue is that if you look at overall serious delinquents rate, as Rick just mentioned, that is coming down. That has now peaked, even with FHA in the first quarter of this year, that's come down. But on the right-hand side, if you take out the foreclosures, if you look at just those folks in 90-day delinquency, that is now bounced back higher, at least if you look at FHA loans and the overall loans. Conventional loans have continued to come down with that 90-day delinquency rate. But this just to illustrate that is going to be a more stubborn delinquency bucket that will need to be dealt with. This is another way of showing that seriously delinquent loans have come down 12% since the peak, whereas forbearance exits have, number of homeowners in forbearance has come down 43%. So you have 2 million people exiting forbearance, but only 310,000 getting out of that seriously delinquent bucket. And the other argument I want to make with this bucket being a problem is, and more time not being the only solution to solve this problem, is that more time is actually starting to backfire for these seriously delinquent loans, despite the fact that home prices are coming up very quickly, and so they have more equity, or in theory they have more equity, but Black Knight did an analysis. If you take into account the additional loan balance, the higher loan balance that you get because of the missed principal, or not principal, but interest and taxes and insurance payments, you actually end up with higher loan balances and less equity for those homeowners who are in forbearance and are missing their payments. And so potentially you could see the percentage of homeowners with low equity go from 10% to 22%, more than double. The percentage of FHA homeowners in forbearance with low equity go from 19% to 36%. So equity is not, I know it's touted a lot of times as the savior of this market, and it is in many ways, but for these homeowners, it's actually giving them more time is actually in many cases backfiring. We see that in our own data. The average price at foreclosure auction is going up by double digits. In the first quarter of this year, we saw it go up 11%. There's high demand for foreclosures, even along with the overall market. But the average total debt on those loans was up 13%. So the debt's going up faster than the values of these homes. So jumping from that into our 5-year forecast, really zooming out very quickly. And I think I may be sounding like a Debbie Downer over the last few minutes, but at the end of the day, if you zoom out, what we're expecting to see with this market it pales in comparison to what we saw during the Great Recession. I don't think that's any surprise to anybody. I think most people by now know that this is a much different environment than the Great Recession, but what we're expecting over the next few years is a total of 1.3 million completed foreclosures in the next 5 years, 2021 to 2025, ramping up. Really, we're getting back to about at the peak of this to 2016 levels. And to put that in context, we saw 4.8 million during the worst of the 5 years of the Great Recession. So there will be an increase, but we're not expecting the tsunami or wave or whatever you want to call it that of the scope that we saw last time around.
Darren, just to put those numbers in perspective, normally about 1% of loans are in foreclosure in a given year. With 50 million active loans, that'd be about 500,000 loans in foreclosure, and roughly half of those wind up being sold either by auction or as REO or going to REO. So that would normally put us at about 250,000 sales a year, completed foreclosures. The number you just suggested, going over a 5-year period, averages out to about 260,000 units a year.
Yep.
So you're basically what you're projecting is over that 5-year period, we get back to more historically normal levels of foreclosure activity. It sounds like that's what you're seeing.
Yeah, that's absolutely it. I mean, the increase that we're seeing is coming off of abnormally low levels during the pandemic. And so at the end of the day, over the 5 years, we're going to be slightly elevated above normal levels, but not much, to your point. And another big shift that we see that I think is important to folks on this call, again, zooming back out a little bit, is the properties that are in distress are much likely to be and there's going to be a certain percentage of those that require disposition where the homeowner cannot, for whatever reason, stay in the home. But we see a shift to more of the pre-foreclosure disposition. We were already seeing that prior to the pandemic. In 2019, on the left-hand side, 33% of all distressed dispositions, if you count pre-foreclosure sales, foreclosure sales, and then transfers to the lender as REO, 33% of those were pre-foreclosure sales dispositions. And actually in 2020, it's looking like it's going to be close to half. And so that's just a market trend I think we're very aware of as a company and trying to take advantage of. And I think folks in the real estate industry who are looking at this distressed market should be very aware of and planning for going forward. And so that ends my focus on really the distressed market. I had a couple things here on the larger market. This ties into what Rick was saying about the demographic trends. And I just was geeking out on the census numbers that came out, I think it was last week. It's not only that there are a lot of millennials who are about to hit home buying age or are hitting home buying age, but where are people moving? And Rick alluded to this briefly too, but they're moving away from the coasts and away from density and toward the middle of the country or toward more even suburban or rural areas. And you can see that the orange here is where net migration increased in terms of population in 2020 versus 2019. This goes through July of 2020, so it doesn't take in all of the year, but you can see those trends. Coastal California, for instance, net migration trends are negative in the blue there, whereas you see places like at least parts of Nevada, parts of the Pacific Northwest, we're seeing a lot of migration too. And so that's, I think, where we're going to see some of the hottest housing markets. We already are seeing some of the hottest housing markets in the country. So I'll I'll end it there so we have time for maybe a couple questions, Rick.
And we do have three, conveniently enough. At least three. So I lost one that was here earlier. Interesting. I think you talked about this a little bit, Darren, but what from Carolyn, what happens to expired forbearances if the moratorium is extended beyond June 30th? If the CD and also if the CDC doesn't extend its moratorium, do you feel that FHA and FHFA may extend their moratorium separately?
Yeah, so the first part of that question, expired forbearances, if the moratorium is extended, those folks will still continue to be protected by the moratorium. And so there's this kind of double protection right now, forbearance and the moratorium for homeowners. And so even in the event of expiration, and you've seen the CFPB come out with a proposal to have, I believe they might call it a cooling off period or something like that, to the end of the year. They're not calling it a foreclosure moratorium per se, but that would keep any foreclosures from being started through the end of the year. And if that takes effect, that would have the effect of a moratorium in many ways. But anyway, they would, if the moratorium is extended, those folks who expire forbearance, assuming they're not a vacant or abandoned property, is going to continue to be protected from foreclosure, and also assuming that it's a government-backed loan. And then on the CDC piece, I believe you're referring to the eviction moratorium from the CDC, which has come under fire recently, but I think that's different than, they do not have a specific foreclosure moratorium, but they do have that eviction moratorium. So I see those as separate issues. And so I don't know if you have any thoughts on that, Rick, but that's.
Yeah, the CDC eviction ban is primarily for rental properties. Although you could extend it into not being able to evict somebody in a foreclosure if there were any foreclosures. The federal court in DC overturned the ban. It was the sixth federal court to do so. It's being appealed, and there was a temporary stay, so the eviction ban's in place. The immediate impact is potential hope for the mom and pop investors who own between 1 and 10 rental units and are often very highly leveraged and have not been able to evict non-paying tenants now for about 14 months. We're seeing anecdotally some evidence of those landlords beginning to sell those properties at distressed pricing. We could start to see more foreclosure and bankruptcy issues among those investors. And again, anecdotally, I heard from one such investor who said when the eviction ban was overturned by the court, it was the first time he was able to get some of his tenants to apply for the government's rental assistance money. There's a $45 billion set aside to pay back due rents and utilities. But this particular landlord wasn't able to get any of his tenants to apply for the funds until there was a chance of eviction. So maybe what happens is we'll see an acceleration of those funds being distributed to the landlords. Question from Lori, and I don't know if I don't have any information on this. Maybe you do. And then I kind of remember the other question that vanished from here. Are there any loans with FHA and VA that are assumable loans? So yeah, those would be much easier to move forward and prevent a foreclosure, and may have some lower rates. I have no data on that. Do you?
I don't have data on that. My understanding is the assumption clause has been taken out of most loans, so that's not available as an option. I know investors in the past had used that, so unfortunately that may not be a path out, but I certainly think some of those loans FHA may return to its distressed asset sale program to sell some loans. So that may be as non-performing loans, which was a tactic used in the wake of the last recession.
Yeah, I wouldn't be at all surprised to see some of the tactics and techniques, particularly the ones that came to play during the Great Recession, be dusted off and used again. In fact, one of the other reasons I'm optimistic that we'll see most of the people coming out of forbearance do so successfully is because of the loss mitigation waterfalls that were developed as part of the HAMP program and some other programs 10 years ago. So for those borrowers coming out, the servicers have the option of extending the terms of the loan to lower monthly payments. They have the opportunity in many cases to lower interest rates, which again would reduce monthly payments. And then finally, there's the opportunity to defer some of the principal balance to later in the loan. So a lot of tools at the disposal of the investors. Yeah, and this is a question that was in chat. So, and I think you were trying to answer it, Darren. But,
Yeah.
I live in northern Nevada. The numbers show the complete state. I believe the numbers would be very different if you remove Clark County from the data. That's probably true. I suspect that's similar in several states. And how can you find numbers that are more local? Skip, your point is extremely valid. I'm originally from Pennsylvania. I can tell you that Philadelphia numbers and Pittsburgh numbers are nothing alike, no matter what numbers you're looking at, with the possible exception of both baseball teams are mediocre. Yeah, so Darren, do you have any sources for more localized numbers for anybody looking?
Yeah, absolutely. I mean, on the foreclosure numbers we have from auction.com, we can drill down further than the state for sure. And then on some of the FHA numbers, the source I was using there, and I think I had the state level numbers. Actually, I had metro level there. So, but anyway, the source for that is if you go to HUD Neighborhood Watch website, you can download that same data down to the metro level. It doesn't go down further than that, but that would allow you to center in on Las Vegas and other metro areas.
Are there any other questions before we wrap up for today? I want to thank AREAA for inviting Darren and I to come share some thoughts with you today. I appreciate all of you sticking around throughout the whole session with us. I hope you found some of this information useful. I don't see any other questions. So Darren, any parting comments?
I would just, it looks like we might have got one. Oh, no, we got that one. Sorry. Might would have got one more here, but you know, one conclusion I would make is that yes, we are going to see more inventory come on in many different ways. One of those will be with distressed properties, and we are expecting really in 2022 to see that distressed source of inventory open back up, and by 2023 being back above even pre-pandemic levels is kind of the big picture we're expecting. Do we have time for this last question, Rick? Or
yeah, Jan Lu says that your foreclosure trend forecast is based on the forbearance and moratorium projections, but many homeowners have lost their businesses and income during the pandemic and won't be able to recover, even if the economy recovers gradually. Their properties are likely to end up being foreclosed. So do you factor that into the forthcoming wave of the foreclosure surge?
Yeah, actually our forecast that I showed on that slide that goes through 2025 is not based, we're not starting with forbearance or moratorium there, even though I talked a lot about that in previous slides. We are using the primary drivers of that forecast are unemployment and equity. Yep. Unemployment as a driver of distress and equity as a cushion against distress. And so using that, we try to use a broader metric to drive our projections. And so I think it should, at least in theory, take into account that broader picture. Now, it all hinges on what happens with unemployment. We're using the Congressional Budget Office's forecast for unemployment. And that has unemployment coming down fairly quickly, down to hitting 5%, I believe, by the end of 2022, and getting back to 4% by the end of 2025. So hopefully that helps. It, of course, it's not a perfect science knowing what things are going to happen, but that does take into account a broader perspective than just the forbearance and moratorium numbers.
Yeah, that's an important point to make, Darren. I was on a session with economists from Wells Fargo and the MBA a couple days ago, and the Wells Fargo economist suggested that we could be back at pre-pandemic employment levels as early as the early part of next year. So this is not a gradual economic recovery. This was an economic shock that caused an immediate drop in the economy, but it's come back much more quickly and strongly than almost anybody had forecast. There will be casualties along the way, but if you equate unemployment rates and jobs to what we typically see in the default servicing industry in terms of delinquencies and foreclosures, I'm actually completely in line with what Darren's forecasting. I think that really is based more on the overall economy than it is on what's going on with forbearance and the moratorium. Those two things are artificially skewing the numbers right now, but will normalize over the next couple of years. A question about getting the slides. I believe AREAA will be communicating with all attendees and making the slides available. I'm pretty sure this has been recorded. In fact, I see the recording button flashing now, and I believe that a recording will be made available to all attendees. Certainly feel free to reach out to Darren or myself individually if you'd like. You can find us both on LinkedIn. We're not apt to be hiding too much. And again, I think we'll call that a wrap, but thank you to Vince, to AREAA, and to all of you for inviting us here. And I hope it was a good session for all of you.
Thank you very much.